Hello everyone, welcome back to the channel. Today we are diving into something every investor and trader wants to master at some point of their trading career, identifying market bottoms. So let's be honest guys, so how many times have you thought that this must be the market bottom only to watch the prices drop another 5%, 10% or even 20% at times? Buying at the bottom of a market downturn can lead to incredible returns, but it's also incredibly difficult to get it right always. So here in this video, I'll share the key indicators and reliable price action patterns to identify potential market bottoms. So these are the things which we are going to discuss. So before we start guys, remember to hit that subscribe button and notification bell so you don't miss any of our trading and investing content. So first of all, let's start with what is a market bottom. A market bottom, it is also called as a swing low. The prices will be going downside where continuous previous lows will be breaking, and at some point of time you will see a total turnaround and prices breaking the previous highs. So this is the previous high and prices starts going upside. So this we can call it as a swing low, or the market has bottomed out at least for temporarily. If you look at this Reliance COVID chart, so what happened? The market has topped out at some point of time, and there was a downfall at some point in the March and April. Market has bottomed out, and prices have started breaking the previous high levels, and it started going for higher highs. So this we can call it as a market bottom. We can broadly classify these market bottoms into two types. One is a sharp V-shaped bottom. So this happens whenever markets are overstretched or the negative sentiment itself has been overestimated. So at this point of time, there will be some kind of sharp reversal. The other kind of market bottoms is broader bottoms. Let's take this Wipro for example. There was a down move in the year of 2022. So after some point of time in 2022 itself, May to 2024, the market has bottomed out. So unlike as we have seen in Reliance, where the markets have bottomed out sharply, here it has bottomed over nearly 1 to 2 years. This is where the strong accumulation you will see from the FIIs and all. So these are the two types of bottom. And now we look at the technical and price action pattern to understand where the bottom might happen. Volume is the first indicator in the raw price action if you are looking for market bottoms. So if you look at this SBI chart, so focus on this area. There was a down move from the previous high. Here there was a dumping of volumes, especially in this area. We call it as a selling climax in Wyckoff theory. So whenever you see a strong volume and a strong downtrend, that is the first sign that there could be a panic selling, and most of the people's the big institutional traders who are holding the huge volumes, they are unwinding their quantities. So there is a possibility of turnaround in the near future. So one more thing what you can observe is that volume divergences. So focus on this area, the same example SBI, State Bank of India. So here there is a good amount of red volume indicating prices are making lower lows and big people are exiting. But at the same time, focus in this area. Though the prices is making lower lows around this area, volumes have not significantly increased when you compare to these volumes. So this indicated some kind of divergence is there. As per volume spread analysis, volumes also has to increase. If it is decreasing, there is some kind of divergence. So there is a good possibility prices might turn around at some point of time. So one more key pattern is that double bottoms, triple bottoms like this. So if you look at around this area, you have seen a one bottom, and here there is a one bottom. So there are plenty of patterns in this similar scenario. You have something called cup and handle, which will form like this. This is also a double bottom where you will see a lower bottom and a higher bottom. This higher bottom indicates there is a strong buying pressure. Once there is a breakout, good possibility of strong up move might be there. Many variations of these double bottoms, triple bottoms are there. So basically this is one price action pattern. And one more thing, so using indicators like RSI, so whenever the RSI is near to 30 or below 30, look for a divergence. So like it happened here. So if you focus here, around this area. There is a lower low around this area, and the RSI itself couldn't able to, despite of prices making lower lows, RSI couldn't able to make further lower lows. So the RSI itself is making higher lows. So look at this area also. So even though prices have went below the 30, prices couldn't able to make a lower low. So this indicated some bullish divergence is there. Likely prices will turn around at some point of time. So one of the price action pattern you can also look for around the bottoms is that watch for 3 to 4 candles next to the bottom. So let's say if you thought that this is the bottom, you watch for the next 3 to 4 candles. If the next 3 candles high has been broken, likely the market bottom might have formed. The same thing here. So these are the 3 candles. Somewhere around this area the prices have broken, but it has not sustained. So here around this area it has sustained. So prices started making higher highs. So whenever you are looking for market bottoms, watch for the previous price action. So this is the previous price action where there is some kind of accumulation. So around this area, same accumulation has been seen. So around, if at all there is going to be a breakdown side, look for huge volumes while the price is breaking down. So as I said, once the price breaks out, if at all the breakout is genuine, you will see strong red volume. If that volume is not there, or if there is a sudden rejection in 1 or 2 days with high volume, then that is going to indicate the buyers from this area are trying to take control. So watch for previous high breakout and try to take a trade in the opposite direction. Don't depend on single thing. So watch for multiple confirmations. Now we are going into the sentiment indicators. The classic symptom of any market bottom or market top is you will see some kind of euphoria at market tops, or there will be a panic when the market is going to bottom out. This has happened during 2008 where the market has crashed because of housing bubble, or it could be coronavirus. When the market have crashed during corona, people were saying it will come down to 5,000 or something like that. So you will see absolute panic. So that is the time where you will see stock prices at dead cheap rates. All the TVs, magazines, newspaper, they'll be stressing on the markets will further fall. That is another sign markets are going to bottom very soon. So why this happens is that if you understand human psychology, we have a tendency to overestimate the fear. So during COVID, if you look at VIX has spiked to 80 to 85. Normally, India VIX generally stays at somewhere around 13 to 14. But when VIX has spiked to 80 to 85, it speaks about absolute fear has captured the investors. That is the reason you have seen sharp recovery in the markets during COVID. So one more indicator you can watch for is the put to call ratios. So these put to call ratios, whenever is very high, like 1.5 or even more, that means that too much of bearishness is there, too much of pessimism is there in the market. So likely market might turn around in the near future. One more thing you can observe from the investor point of view is that mutual funds or ETF outflows will be at record highs. Retail investor selling will be at high levels. Now let's look at the fundamental indicators. Coming to these fundamental indicators, first thing is that you look at the P by E ratios. So these P by E ratios will be below the historical averages of those stocks. So that indicates there is a extreme bearishness in the market. Again, markets will likely turn around at some point of time in the near future itself. One more thing you can look for is the dividend yield. So whenever you see dividend yield increasing to the attractive levels, big players will enter the markets, and then that increases the confidence. Likely the prices will turn around. So one more indicator that tells you market bottom might be near is price to book value reaching to the multi-year lows. That says that the stock price might be undervalued. So that is the time where the investors for long term, 3 years, 4 years, they try to enter. So before we put it all together, just remember guys, the best bottom occurs when even the most terrible news no longer drives the prices lower. So that is when markets stop responding to the bad news. This you will see very often. So to put it all together, guys, always try to prepare a checklist what you want to check. So have two indicators in technical analysis. Try to understand the sentiment, understand your own emotion itself, how you are reacting to some negative news, whether the stock prices have already priced in, how much the prices have fallen, and where the market have previously accumulated. So likely around the previous accumulations there is a possibility of turnaround. So try to understand all these things in a very neutral way, and when you want to start accumulating, don't put all your money in a single go. Try to allocate it in tranches. This is how big institutional traders do, and don't put all the amount in single stock. Also try to diversify as much as possible. Put 10% of your amount in one sector, another 10% in another sector. So try to diversify among sectors, among instruments also. So not only stocks, go into the bonds, go into Nifty Bs, go into gold ETFs like this. Position sizing should reflect your uncertainties. As a conclusion, guys, let me tell you, identifying market bottoms is part science, part art, and always challenging. The perfect bottoms doesn't exist. So most of the people, they might go wrong, because at market bottoms, that is where there will be absolute panic. But with these tools, you will better be equipped to recognize the opportunities when the markets have been oversold. Remember that investing is more like a marathon, not a sprint. Your goal is not to catch every bottom perfectly, but to build a process that keeps you rational when markets aren't. If you find this helpful, guys, please hit the like button and share with the other investors or traders who might benefit. Drop your questions in the comment box. I'll do my best to answer them. Until next time, happy trading, happy investing.